Welcome back, everyone, for today's segment. Today's going to be an interesting one. We're going to go over two valuation metrics that I think people should be using in this crazy market to understand if you're buying stocks at a good value or not. Okay, so we'll go over that today. And also, I just want to say thanks to all the subscribers that came to the event to learn about private money lending. As I said before, be sure to subscribe because those that do subscribe get access to these events. That said, let's get started. Welcome back, everyone. So today I'm going to hit on two metrics that I use to understand where a stock is in terms of its valuation. Now, I think the recent run-up in the stock market, I was warning people back in late August that, when you look at the stock market from a valuation standpoint, it just doesn't make sense. And really, when you look at the history of the stock market, it was the second or third most expensive time to be buying stocks. And really, when you look at the underlying performance or growth of their earnings, it didn't justify those prices. And so, it's interesting because if you're a sheep in the stock market, you're going to get hurt. You have to, think the opposite of others to make money in the stock market over the long term. And so I was warning my clients, please be careful. It's a dangerous time to be investing. And fast forward to today, September 8th, and you're seeing the contractions in the prices that I would expect. In fact, I actually think there might be some more contraction in the stock market. So do be careful there. So the first ratio or metric that I want to talk about, it's pretty well known, and it's one of the very quick ways that I look at a stock to say, is it in a valuation standpoint that I can justify? And that's price to earnings ratio, or commonly known as the PE ratio. Now, the PE ratio, very simply, it is what people are willing to pay for $1 earnings. Now, it's not always a metric that you can rely on for, let's say, hypergrowth companies that are in their early stages, not making money, but growing very quickly on the top line. You want companies to be reinvesting their profits into R&D, into the growth of their sales and engineers. And so simply using the PE ratio for newer companies isn't always the best option, but it's really fantastic for mature companies, companies that have been around for 20, 30 plus years, that have profits that the street values, not just revenues. So the PE ratio more or less says, okay, well, on average, what do people pay for $1 earnings? Well, historically, the S&P 500, tends to pay between $15 to $17 per $1 earnings. Now, just recently, when I saw a lot of risk in the market, I was telling people this at a point where the S&P was between $29 and $31 per $1 earnings. That is extreme. And if you look at most pre-recession, points, you can see, above 25 PE is really risky. So that's number one. Number two is something called the PEG ratio, PEG ratio. And this is essentially a more advanced version of the PE ratio, okay? What it does is it says relative to the growth of earnings, what should this stock be priced at? Now, if it's below a 1.0, then arguably this metric says that it's undervalued relative to the earnings growth. And if it's above 1.0, then it's relatively expensive for the amount of earnings growth. And again, it comes down to more mature companies. This is not necessarily a metric that you can use for newer companies, because again, newer companies, tech companies, are usually based around top line growth, right? And then they redrive those earnings into R&D, into engineers, into salespeople. It's a different model. But if you're a value investor, you're probably looking at some tech companies, but a variety of non-tech companies. And so these two ratios, if used correctly and in tandem, should give you a relative basis to measure your stocks on. Okay. Now, again, that's the PE ratio and PEG ratio, and that's just the surface level. You might want to start there and then dig deeper as to why the PE ratio is high or why it's low. Okay. And that's kind of the journey of picking a stock. And if you're buying at the right time, or generally the right time, then at a standpoint where the PE ratio increases, it might be time to take some profits off the table and then realign your portfolio. So anyways, these are just 2 quick tips that I have used in my investing, and it's paid off very nicely. So I recommend you do the same. And again, any subscribers out there that want to get on our lineup for new guests or reports or events, be sure to subscribe. And if you like what you heard today, be sure to give it a thumbs up. Thanks all.